Welcome back, Fail-Safe investors. And if this is your first time to my page, welcome to Fail-Safe Wealth, a financial channel where I do my best and try to give you some advice in overcoming some of these obstacles when it comes to investing into the stock market and take some of the gambling out of investing in the stock market because it's really not complicated. So I just do my best to try to get the message across and how to invest, how to get started in investing, companies that I'm looking at investing in, some terms that you might know or need to know when it comes to investing, and all those type of things. I try to cover all that on my channel. So welcome to Fail Safe Wealth. Let's get into it. Let's go. In today's video, I'm going to try to get the point across the importance of understanding the company that you are investing in. Because if you don't understand the company that you're investing in, when you see a little volatility, you might likely just jump out because it is kind of like gambling. And with gambling, you do not want to lose. Now, I get that. But one thing you should understand when it comes to the stock market, you don't lose unless you sell. So you have realized gains and unrealized gains and losses. So a realized gain or loss is actually when you sell and you have cash, like you liquidate your portfolio, you have cash. So that's a realized gain. An unrealized gain or loss is when you buy into a stock and the price of that stock goes up or down. That is unrealized because technically that money isn't yours until you sell. And based on the price point that you're looking at, that can change like that. Believe me, I've seen it. So pretty much I'm going to tell you a story about one of my investments and why I chose to invest in this company. And hopefully you get the point of the story of which I'm trying to get across is understanding the company. So one of my investments that I invest in that's in my portfolio, and I invest in this company regularly, it holds a large percentage of my portfolio, is Discover Financial Services, ticker symbol DFS. Now Discover is selling for around like 50 bucks right around now this week. At its low, it was around like 30 bucks a share. I think I started picking them up at like $34 a share, 36. I built up a large percentage around that point. I think I had like 20 shares at the $34 or $36 price point. And its high for the year, or its 52-week high, was like, I think like 80 or 90 bucks, if I'm not mistaken. Now, what made me start looking at Discover Financial Services was I wanted something in the financial sector. Now, not only did I want something in the financial sector, I wanted something that can grow. So I wanted something that had value, something that was undervalued, and met all of my criteria when it comes to an undervalued stock and had room to grow. And not only had room to grow, was big enough to grow and expand its business. So with Discover Financial Services, I started off with like looking into Square Inc. If you haven't heard of Square, I started looking into PayPal, Visa, MasterCard, American Express, and that's how I came across Discover Financial Services. So I don't want to get too much into all these because even though all of those are in the same sector, they operate very differently. So let's just stick to Discover, Visa, MasterCard, American Express. So those are your four top credit card issuers or credit card holders that you probably heard of. Visa, of course, you probably heard of MasterCard, American Express, and Discover. Those are your top four. Like when you go into a store or anything and you swipe your card, you'll probably see their logos on any like card reader or anything like that because those are your top four. Those are your biggest. And pretty much any card, credit card or debit card issued, will have one of those four logos on the card, and there's a reason for that. So the reason why Visa and MasterCard are the two you'll see the most is because of how they operate. So Visa and MasterCard kind of operate like a toll road. So let's say that in lines of credit, or like how credit operates, let's say the money that you could use as credit or that's credited to you would be like the vehicle or the car. That comes from the bank or a lender. We'll just say a lender. That comes from a lender because I don't want to say really a bank, but you'll see how the terms kind of overlap as I talk. So those come from a lender. Now, the transaction itself of like you going into a store using your credit card to pay for something, you being able to walk out of the store with that product, your shows you're approved, and then the money leaving your account later, that transaction is facilitated through networks like Visa, MasterCard, American Express, and Discover. So those are your four prime networks when it comes to those things. So like I said, if the lender is like the car, the vehicle that's getting you there, the facilitator for this case would be like the network. So Visa and MasterCard are like your toll rolls, pretty much. You're paying to use the toll. So they charge like 1 to 2% for each transaction, but they do not lend out the money. So you have to remember that these Visa and MasterCard, your two largest, they do not lend money. So the liability is very low with them. They just offer a service, and the creditors or the lenders use their service to pretty much fact check the card or fact check those things. So that's pretty much why you see Visa and MasterCard a lot. Even if you have like a government issued like debit card, like the Way to Go or like a food stamp card or something like that, it's usually Visa or MasterCard, because all they do is charge a service for the transaction is like 1 to 2%. So these companies are huge. Now, with that being said, American Express and Discover couldn't necessarily build up the same networks like Visa and MasterCard. Those two, they dominate those markets. Like, they literally dominate it. So what American Express and Discover did was they kind of became a mixture of the lender and the toll road at the same time. So what makes American Express and Discover different from Visa, MasterCard, or any bank is that they lend you the money, so they receive the interest rate being paid from that money being lended, and they facilitate the transaction. So they do kind of both, and that's what made me look into Discover. So when I seen that, and I'm like, okay, this is revolutionary right here. So they can lend out the money, charge a 21% to 23% interest rate on that. So if you spend $100 and you leave that balance on your credit card, they can charge you $21 to $23 just for you leaving that balance on your credit card. That's a lot of money right there to be made, which they do. They made $10 billion just in interest payments alone. And by them, I mean Discover Financial Services. They made $10 billion in cash just from interest payments, because that's how they generate their revenue. Their 80% of their revenue comes from interest payments. So you have to understand accounting. So when the stock market took a dive in March, I was already following Discover Financial Services. I was already planning on investing into this company. So I watched this stock go from 80 something dollars a share all the way down to the like 28, 29, which was his like low, absolute low. And then like settle around like the 30s and low 30s pretty much, to say the least. And that's when I knew like I have to get in, because this is a once in a lifetime opportunity. I have to start buying this company, right? So I started buying the company, and what made me really jump on this company over American Express is the price point. It was very attractive. It was $30 a share. I can build up a large position. And like I said, there was still room for growth. So when I started investing in Discover Financial Services, the price to earnings ratio was like a 7. The price to book was like I think a 0.9, which means that I'm paying 90 cents for every dollar of assets that this company owned. I already knew that they didn't have that many employees. I think it was like 10,000 employees at the time total. They operated out of 2 headquarters or 2 buildings, literally just 2 buildings. So their overhead is very, very low. All of the metrics hit it for me. And then they had brought in $6 per share in 2019. So this company definitely can bring in revenue. I also knew that they target the middle class for approvals for their credit cards. And that was also very attractive, because I'm thinking in my head, like, okay, in this pandemic or whatever we're in right now, 9 times out of 10, in my opinion, a lot of people will still keep their credit cards and just pay the minimum, which works for me if I own Discover Financial Services. Because if you're paying your minimum, then pretty much you're just paying interest. And if you're just paying interest, that means that's more money on the back end for Discover, which works out for me in the long run. I loved it. And I knew that nothing about this company fundamentally changed. I knew that nothing fundamentally changed about this company. The stock price simply went down because the entire stock market took a dive and everyone was pretty much just getting out of all stocks. So that is what really made me jump on this. And I'm pretty much still building up my position in this company. It's around like $50 a share. I think I mentioned that already. And I'm still like buying shares because it's highly undervalued. Now, the intrinsic value of this company as of today is $138. So there is a fair value for this company, $138. Just think about that. Now, before the dip in March, the company fair value was around $225 a share. So just think about that. You're paying $50 for a share that should be selling around $100 right now. And that's why I plan on building out my position in this company. And a lot of people say that it might be selling for around $50 for like the next 3 years. I hope so, literally fingers crossed, because if it does sell for $50 for the next 3 years, that means more shares that I can buy up. And when it actually does go up to its fair value, I'll pretty much just have a huge return on the back end. But that is one of the reasons why understanding the company and how it operates before you invest in it is very important. So keep that in mind. And like I mentioned, Visa, MasterCard, American Express, and Discover does not operate like your normal banks. And since Visa and MasterCard only charges to facilitate the transaction, a lot of banks get rich off of credit cards, especially JP Morgan. When they issue a credit card, they are the one that's lending the money. So that means they are the one that's receiving the interest rate money. So you have to keep that in mind when you're looking into a company. This was definitely the one for me. So I have a company in the financial sector and they still pay a dividend. So in June, I received a dividend for like $12, and that's just one of many payments. And the more I build up my position, the more that dividend payment will go up. So if you like the video, give it a thumbs up. If you haven't subscribed to my channel, you have subscribed to my channel. There are more videos like this to come in the future. Tell me what you think about this video and tell me if you actually have a better understanding about Discover Financial Services. If you don't, we can talk about it. Talk about it down in the comment section. But hit that like button. See you on the next one. Let's get it, let's do it.